You're listening to the Moneyweb Now podcast series with Simon Brown. Live streamed every weekday at 6:30 a.m.
It's Wednesday, 26 August. We've got NVIDIA and CrowdStrike results after US close tonight. I'm Simon Brown, coming at you live and loud from the Moneyweb studios in Gauteng, Johannesburg. On the show today, Chantal Marks, F&B Wealth and Investments, Goldfields results. To be clear, if you're a gold miner right now, printing cash is just like resting state. We get her thoughts. There's also some Ghana worries there. And then Grindrod, I gotta say, I don't know, I like Grindrod. I think it's a great little business. HEPS was flat. Let's get Chantal's view. We're going to be chatting with Experience South Africa Business Debt Index shown 4 quarters of improvement. That's got to be good news. And then a global chief analyst at GTC. Economic data, does it even matter in current markets? There's so much noise, headline-driven moves. Does good old fundamentals still count? This podcast is brought to you by Stanlib Asset Management. Invest in more global opportunities through their partnership with JP Morgan Asset Management. Morning headlines: Moneyweb, FSCA confirms insider trading investigation into Curro shares. These are these trades that happened just ahead of the ultimate delisting. And Business Day, Northern Platinum up for grabs after unsolicited offer. Lots of T's and C's here. Maybe it's Glencore looking for the chrome. Maybe it's Volterra looking for PGMs. A lot still to happen here. Morning markets, US was green, S&P up almost 1/3%, Nasdaq just over 0.5% higher. Easter's mostly green, Sydney the exception, off 0.5%, Tokyo little over 0.5% up, Hong Kong 0.7 higher, and Tencent a full percent higher. Commodities mostly red, gold futures 4,708, Brent 86.11, platinum is the green 1,879, palladium 1,364. The rand is 15.91, Bitcoin is 79,000, and top 40 opening call, green open 170 points, little over 0.15% higher.
Moneyweb Now, on the money. Also available on podcast.
Chatting now with Chantal Marks, she of course head of research, F&B Wealth and Investments. Chantal, always appreciate the early morning time. The Goldfields results, I said it, tongue in cheek, but not untrue. If you're a gold miner right now, printing cash is just default, right? You've got a cost of around 2,000, you've got income of around 4,000. The numbers are giant, and frankly, we expect no less.
Yeah, absolutely. At this point in the cycle, these guys are doing exceptionally well. And they can do one of two things with that money. Yeah. They can either invest it into new developments or they can give it back to shareholders. Ultimately, you want a nice balance. It does seem as if Goldfields is favoring the shareholder right now. But as you mentioned in your production, there's a bit of an overhang there. So I think that they're trying to keep shareholders happy right now.
I would argue there's a third one, which is waste the money. But I appreciate that's probably not a boarded group discussion. They've got that challenge with Ghana. I'm not going to try and pronounce mine, but there was was it last year, the year before, a lease expired. The Ghanaian government said, cool, we'll take it, please. They've got a lease expiring in April, and there's a real risk. The Ghanaian government might do it again.
Absolutely. I think that unless they get some sort of feedback from government or we get better clarity in terms of mining policy in Ghana, this is going to be an overhang until that answer comes through. And then it will be an overhang every single time it happens until you get that clarity. It's very frustrating. And the way that the Goldfields management team has kind of framed it is that it seems to be quite opportunistic from the Ghanaian government right now. And it reminds me of MTN and their troubles in Nigeria a few years ago. Yeah. Goldfields saying they're an easy target right now, or miners are easy targets, and government seems to be taking advantage of that.
Yeah, I hadn't thought of that. It does smack of the MTN disasters in Nigeria. Let's change track. Let's move to Grindrod. Revenue is flat. HEPS was up. They had some challenges. I thought they had flagged it. The update spooked the market, but this is still a nice little stock, I think, in a great space and doing well. Your thoughts on Grindrod?
Yeah, I think with Grindrod, you need to look at the year ahead and the year after that and the year after that. The results that they put forward yesterday really, I mean, they're always backward looking, right? And they had some rail stock that's been idle, but the Transnet concession is starting up next year, so that won't be a situation for them. I think it will be quite positive for them. And you've got lots of changes in their ports business. They've consolidated one of the terminals in Mozambique as well, and their volumes are still volumes are exceptionally strong, and they continue to benefit from the investment that they've put in there. So, I think with Grindrod, you need to look ahead. I think we could expect better things for them next year and the year after that. I think the only caveat being that they are mainly handling commodities. Yeah. Commodities are very cyclical, so you need to know that before you invest in the business.
I take that point. There's also, I mean, part of their winning has been the demise of Transnet. Transnet is improving. My sense is that Grindrod's kind of entrenched themselves, and they're now going to exist alongside Transnet rather than Transnet push them out. Is that a fair thought?
Yes, absolutely. I think that one of the ways that Transnet is trying to improve itself is to have more public-private partnerships. And Grindrod has been around for a very long time, filling the gaps. So I think that they're a natural partner, or at least one of the natural partners for Transnet in their turnaround strategy. Yeah,
actually, that's a good point. If anything, they're part of that strategy. Chantal Marks, FNB Wealth and Investments, where she's head of investing. I appreciate the early morning time. Let your money benefit from experience with Stanlib Asset Management. Find out about Stanlib Global Select Fund, which follows an investment discipline that has delivered results for 3 decades.
Moneyweb now on the money.
Staying with Matitetso Medito, Chief of Credit Bureau Services at Experian South Africa. Matitetso, appreciate the time. The business debt index in Q1 rising to 0.53. Give us a brief indication of what the business debt index is, how it works, and what we're measuring here.
So basically, the BDI is an indicator of the overall health of the business. As well as the whole economy. So it measures the relative ability of a business to pay its outstanding suppliers or creditors on time, and it also tracks the macroeconomic indicators that can impact the ability of the company to pay their creditors.
Okay, hence, I mean, this really is, in many senses, at the core of an economy, that ability to pay debt. And we are seeing it moving in the right direction. I mean, this is, notwithstanding, there's some challenges out there. We can look at some of those in a moment. But it is moving higher. It is showing that things are improving.
Yes, no, definitely. I mean, if you look at the latest reading that has been published, which was at the end of Q1, it is quite positive to your point, and this really signals that more businesses are able to repay their obligations. It was a slight improvement from Q4 of 2025, but certainly a consistent growth that we've seen for the past 4 quarters in a row. This is largely attributed to low interest rates as well as just a favorable perception overall.
Absolutely. And that trend is perhaps the important point. You mentioned 4 consecutive quarters in positive territory. That perhaps is really the headline rather than a single quarter. Tells us that businesses have been in a comfortable space. I mean, that's not shooting the lights out. It's tough out there, but certainly better.
Yes, no, definitely. And I mean, you would see that there's obviously specific sectors that are sort of still in the negative, but a large part of them are above zero, which is the measure that we're looking to get. And you will then see that the mining sector in particular has improved significantly. And then the agriculture, although still in the positive, it did see a major shift. But this was largely as a result of a big growth that we'd seen in the agriculture coming from Q3 on a lower base to Q4 at 19.9%. So we did expect that obviously this sort of a downward trend will occur with regards to the sector.
I remember that Q3 in the GDP data, a giant agriculture number. So you mentioned agriculture declining but still looking better. Mine is obviously having a good time. Where are we seeing some pressure in the economy on this index?
So the pressure is largely still in the construction and the electricity, where these two sectors are below the zero line, but certainly also a sort of a positive trend. So if you look at at both just the construction itself, it was in the negative 0.3 in Q4, but now it's improved drastically, although still below the zero line at about 0.04. And electricity also from 0.3 to 0.4, all in the negative.
And we are seeing,
still sort of drawing closer to that zero line, and we're hoping that obviously what we want to see is above the zero line.
Yeah, and again, it's that directional. It might be below zero, but it's moving in that right direction. And you also
in the right direction, certainly.
Yeah, and you mentioned in the press release talking around how you're seeing sort of other metrics. For example, debt stress ratios improving. There are other metrics that are supporting this at the same time.
Yes, no, definitely. So what we have seen is, so you would see that the overall days in debt has gone up slightly, which is not what you want to see. But if you look at debt that's sitting in the 60 to 90 days, which is where now you're starting to like really show that those signs of distress, that has come down quite significantly. So we've seen a drop in that one in particular. So I think as much as we're seeing that a bit of a stress on the overall average number of days overdue, we're seeing definitely that there is an improvement where, businesses are not necessarily ending up holding out too long. And what we're seeing in the data as well, and obviously just looking at the perception and where the economy is that this would have been as a result of lower interest rates. So with lower interest rates, it's not in the interest of the business to sort of, hold on to money. You want to sort of be able to be servicing your debt. So that's where that is pointing to.
Absolutely. And that then, because if this was Q1, post then we've had a rate increase. Just been one, it was 0.25%. We've obviously had energy costs higher, but that's not necessarily going to derail what we're seeing here in the four quarters. Simply because, if we go back 3 years ago, we had, inflation, way higher. We had interest rates markedly higher. Notwithstanding what's happened in the 6 months since the attack on Iran. Bigger picture and longer term, conditions might be tougher in the short term, but they're better than they were sort of 3 years ago. I mean, we had prime at 11.75 at one point.
Yeah, no, certainly. I think you do have a point. So what we're already forecasting, and I mean that report will be out in the next couple of weeks, but it has forecasted that the BDI will remain in the positive ranges. So we're expecting that there will be a slight drop, but it will still definitely be in the positive ranges.
Yeah, and that then continues the trend we're talking about, which is so very, very important. Yeah. We'll leave it there. It's Madito, Chief of Credit Bureau Services Experience South Africa. Appreciate the time.
The Stand-Up Flexible Income Fund is designed for pre- and post-retirement income and capital preservation needs. Retire without regret with Stand-Up Asset Management.
Building wealth doesn't happen by chance. It happens by making the right decisions. Join John Minyaki from Old Mutual at the Moneyweb Economy and Investing Conference at the Money Summit as he shares practical strategies for building long-term wealth, avoiding common investment mistakes, and creating lasting financial success in the real world. Tuesday, 1 September at the Sandton Convention Center. Register for free using the promo code MONEYWEB. Secure your seat today. Go to moneyweb.co.za and start building a stronger financial future.
Moneyweb now, on the money.
Chatting with Jamil Ahmed, he's Global Chief Analyst at GTC FX. Jamil, appreciate the time today. A couple of things I want to chat about, but I want to start off with perhaps a sort of a big picture. In terms of market volatility, we're very much these days a market dominated by headlines and news. And, Scott Bessent last week going to be buying the 10 and 30-year bonds. That moves the market. Does sort of economic data or even technical price action, does it still play a role these days in this sort of market?
In this current market environment, it doesn't play any role at all. This market this year, since the unfortunate geopolitical crisis that broke out at the end of February in the Middle East, this volatility, which has been phenomenal across multiple asset classes, is completely driven by headline. And I think as somebody who's been in this industry now for well over a decade, coming towards 2 decades.
Yeah.
Since COVID, this is the first year I've known where headlines have driven the market. We're not watching fundamental data. Of course, we're aware, but when you have so much volatility when it comes to geopolitics, any particular economic data release can vary month to month, not really show a trend because we don't know where the world is heading. And it's the same for technical price action. I'm not going to say that we can completely discount these elements because they're very important when it comes to investors watching financial markets. But essentially, yes, everything that's driving the market this year is actually headline, and it's one of those elements where sentimental analysis has played out more than other traditional drivers of volatility and investor behavior. And essentially, I don't see this trend concluding or even coming towards an end unless we have a real peace deal when it comes to geopolitics in the Middle East. And I mean a tangible peace deal, not a memorandum of understanding that then gets thrown out of the window and so forth.
But I get your point around it, and I like your point there, is that a proper peace deal is what ends this. Until then, it is just, there's so much weird stuff happening out there. Normally in a, inflationary environment with energy prices and US inflation, we'd have a sense of what the Federal Reserve would do. Right now we sit here and we have no idea what the Federal Reserve will do. We don't know. There's so many sort of things that we would normally have thought that's going to be the outcome, and it's just no longer the case across so many different areas.
It's not only that we don't know what they're going to do, even them themselves, they don't know what they're going to do. And if you look at the first opening narrative soundbites that we've got from the new Fed chair, I think one of the old, not metaphors, the adage, what we came to be familiar about with Jerome Powell, the former Fed chair, was that Federal Reserve was data dependent. This current Fed chair, the charge that he's leading with is that we're taking things meeting by meeting. And that means that even the world's leading institution, they're uncertain about where the world climate's heading, what it means for the economy, what it means for traditional financial markets, investors, and so forth. So it's not only us that are none the wiser, it's the same when it comes to the central banks. But that means that uncertainty is continuing. We're going to continue to see volatility. And I really would highlight here the importance of investor education, because the volatility that we're seeing is phenomenal. Of course, volatility can come with opportunities. I didn't mean to rhyme there, but it also comes with risk. And
it does come with risk. Yeah, and that then means, and at the heart of any sort of particularly short-term trading, but even in a long-term portfolio, it's around managing that risk. And in the investment world and in the trading world, it's about position size. It's about knowing your leverage and your gearing. That becomes perhaps, it's always important, but perhaps more important, to your point, in this type of volatile and unprecedented market. And I hate the word unprecedented, but it's true.
It is 100% true. It is unprecedented. These are very volatile market conditions. To give you an example, we've seen swings in the price of gold up and down 20% since the breakout of this crisis and the geopolitical crisis. And that's, your traditional safe haven asset. Look what's happened with the dollar index and the greenback just over the past trading week. We're seeing volatility here across all asset classes: gold, commodities, oil, US dollar, foreign exchange. The only asset class where we're not seeing such tremendous bouts of volatility at the moment is in Wall Street, which is surprising some because of the disconnect there from the real economy, but it's also because investors are completely all in on AI. And Wall Street corporate earnings season continues to impress. And I think once we see more blue chip organizations and organizations overall put more investments into AI, and I'm still a bit skeptical about it, but nonetheless, it's seen as improving automation, is seen as improving profitability, and the shareholder value is there. So I think that in some ways, this economic shift that we're undergoing now when it comes to evolution in tech, it's kind of playing out in a way that it's cushioning away from very uncertain geopolitics, and it might even put more investor attention into AI. That's not necessarily a good thing, but we are seeing uncertainty continuing nonetheless on a global level.
I take your point now. Take your point around the AI in particular. Again, great to feed the shareholder, but perhaps we're seeing some crazy stuff happening there. And I'm thinking particularly what we've seen in memory chips in the South Korean market. But we'll leave it there. That's Jamil Ahmed. He is Chief Global Analyst, GTC FX. Appreciate the time.
And that's our poll today on LinkedIn. Is it a harder market for traders? Or maybe, when you think about it, there's always something, right? There's always, some story somewhere. What do you think? Have your vote. Have your say. LinkedIn. That's it for today. We're chatting with Peter Edenhuis yesterday. He, of course, Herenia Capital Advisors. Talking MTN results, their proposed 6 billion rand share buyback. We asked you, is buying back shares the best use of 6 billion? Half said you would prefer a dividend. Almost half. Third said great for shareholders. Rest said no, stock is expensive. Don't buy back shares. Have your vote. Have your say. LinkedIn. This podcast is brought to you by Stanlib Asset Management. Invest in more certainty to navigate volatile market conditions. We're live every weekday morning, the Moneyweb website and the app, 6:30 a.m. Podcast just after 7. Thanks to my team, Eddie Nobochlet, Nicole Sabu, to you for listening, my guests for their time. My name is Simon Brown. This is Moneyweb Now. We'll chat again tomorrow. Bidcorp results.
You've been listening to another Moneyweb Now podcast, posted every weekday at 7 a.m. on moneyweb.co.za. Moneyweb Now, on the money.